Hello, this is Matt on the Moon Lambo channel. If you're worried about the price action that we've seen over the last couple days in crypto in particular, this is the video for you. This is something you're gonna want to watch here. And yes, it's the case that Bitcoin has crashed on down from its all-time high. As of the time I'm recording this, it's reached as much as 21% below its all-time high. Oh no, the sky's falling. Yeah, I don't think so, folks. I do not find that compelling, and I've been through too many of these freaking drawdowns to get scared by this. Also, even if we were entering a bear market, it wouldn't change even the tiniest thing that I do in regard to my approach investing in the crypto asset class, because I hodl. I'm all about that hodl life, son, so this literally wouldn't change anything for me. Sometimes bear markets happen, and then you end up in a bull market at some point in the future if you wait long enough, and then even more money plows in, and then you still get rich. So either way, it doesn't make sense to be down and in the dumps or sad and panicking, anything of the sort here. The best is yet ahead, but I'm going to share with you a rather compelling case as to why we are not entering a bear market right now. And this case was put forth by Ral Paul. He is the founder and CEO of Real Vision, as well as global macro investor. Well, sorry, folks. Take a little sip of water here. That came out of nowhere. I don't even have a cough right now, but that just happened. So anyway, Ral Paul, he's the founder and CEO of Real Vision and global macro investor, and former Goldman Sachs executive. He also happens to hold some XRP, and I got to tell you, he's one of the most data-driven individuals in all of crypto. There's a reason that he has over 1.2 million followers on X, and I'm still learning from him. Like he's one of the guys, by the way, that made it very clear that there was at least a possibility that we could be seeing the cycle top for crypto, not this year, but into 2026, maybe even second quarter of 2026. And he was saying that he was making that thesis known about a year ago. It was either late 2024 or maybe early this year, 2025. But he was articulating that, and it seemed less convincing to some people. It's like, wait, you're telling me that we've been on a 4-year cycle till now, and up to this point, but now we're on a 5-year cycle? And yes, but he has logic, reason, data behind all of this. He didn't just whimsically come up with this. And so he's articulated that case. I shared it on the channel at the time, and even though there were only a few people in support of this theory until very recently, I've always respected his perspective so much that I was like, okay, this guy's data-driven. He doesn't just say a bunch of crazy stuff. He's got a good track record, even though nobody's perfect. I was like, yeah, let's talk about this. And now more people are finding it rather compelling as we're reaching the end of 2025, and we haven't even had an alt season yet, right? And as I'm recording this, Bitcoin's just a hair below $102,000. XRP's at $2.24. So even, I'll just say this, even if by the time you're watching this, the market's cratered even further, that doesn't change anything that you are about to hear in this latest Moon Lambo hot jam. And so this is a long post. This is, again, from Ral Paul here, and I'm going to share with you some additional explanations on some of these things that he's talking about here, along with some of my own thoughts. And also, there was at least, I can't remember, 1 or 2 things he talked about in here, metrics that I was not familiar with. So, so I guess it kind of goes to a point like that I was saying earlier. Like, I'm still learning from Ral Paul. He's just a wealth of knowledge. And so I learned a couple new things. So a lot of this I had shared on my channel because he's been talking about some of this stuff. It's just like an updated perspective. But, I mean, he shared this post, mind you. This was on Tuesday after markets had crashed. So look, this is already in the evening. This is 5:34 p.m. Central Time, November 4th, Tuesday. So, Bitcoin had already hit its 24-hour low of, $98,000 or so. XRP had already gotten as low as $2.09, according to Live Coin Watch. And so it's bounced up a little bit since then. But he already saw that, and he's like, yeah, this is not the end of the world. And so here's what he wrote. He said, I know no one wants to hear bullish ideas, and everyone is scared and wants to fling poo at each other. But the road to Valhalla is getting very close. If global liquidity is the single most dominant macro factor, then we must focus on that. And folks, that is at the core of his thesis. It's global liquidity. He's the reason that I am aware of the importance of global liquidity and how that impacts risk assets, including the stock market and cryptocurrencies. And I've talked about it a lot on my channel since I've learned about it. Because, and I still believe this is true, there's no end all be all. There's no like one metric you can look at to determine what's going to happen in markets. Of course not. That would be a way too simplistic and incorrect approach. But when you're talking about global liquidity, that's the closest you will get to such a thing. There isn't one such thing, but if you wanted one thing that will give you an indication of where the market's going, this is the closest you're going to get to it. And so that's why when he says, and that's the way I always articulate it, but that's why when he wrote here, global liquidity is the single most important dominant macro factor, then yeah, we do need to focus on that. And he's right about that. And he says, remember, he says that the only game in town is rolling $10 trillion in debt. Everything else is a sideshow. This is the game of the next 12 months. And so that $10 trillion figure, it's just U.S. government debt that matures in the next year, and it just has to be refinanced. And so, of course, that forces huge liquidity decisions that impact markets, and that's what he's talking about. It's going to happen, and that is going to impact liquidity. And so then, as people, businesses, and institutions have more money available, which is the net result of that, as that happens, those funds have to be put somewhere. And if you've got more money, maybe you're willing to put a certain amount of that into riskier assets, stocks and crypto. And maybe you're willing to go further out the risk curve. And historically, that's what's happened every single cycle. So it's just that the debt refinancing timeline has changed. It was every 4 years, but thanks to the pandemic, it's now been pushed out further. And so as Ral Paul, I've seen him articulate this in the past, he said typically the refinancing would take place between 3 to 5 years, so it would average out to 4. That's why I got the 4-year cycle. And now he says that it's pushed out in such a way that it's averaging out to 5 years. And he's been talking about this for a very long time. Once he saw that and the impact of various other metrics, it seemed pretty clear to him that there's a very real chance that you're going to see the cycle peak in 2026. And now it doesn't look so crazy, does it? Anyway, and then he says, currently the government shutdown has forced a sharp tightening of liquidity as the TGA builds up with nowhere to spend it. And so the TGA, that stands for a Treasury General Account, that is the government's bank account. So when it fills up, markets lose liquidity, and when they spend it, markets gain liquidity. So during a government shutdown, the Treasury can't spend normally because Congress hasn't authorized funding. So spending slows or pauses, but tax receipts and debt issuance, that can still come in, depending on timing and emergency authority. But look, that means money keeps flowing into the Treasury's account, the TGA, and money stops flowing out to agencies and then, contractors and salaries programs, et cetera, all that stuff. That's what's happening. So that's another piece of this. He's saying funding there, not going out, not being dispersed. Yeah, that tightens liquidity. That's exactly what that does. And then he says this is not offset by the ability to drain the reverse repo. And then he wrote in parentheses, it is drained. And he says, and quantitative tightening drains it further. And so most people don't realize, but the Federal Reserve has basically a kind of emergency cash pool for the financial system. And it's called the reverse repo facility. And this is where money market funds should be run by firms like BlackRock, Fidelity, Vanguard. That's where they can park excess client cash overnight when they want safety and a guaranteed rate. And so it's short term. But it's cash from corporations, pension funds, banks, institutions, and just everyday investors who are sitting in money market accounts. Now, over the past year, that cash has been flowing out of the Fed's reverse repo system and into Treasury bills to support government funding. So the reason is that when yields on Treasury bills become equal to or better than the rate that the Fed paid in reverse repo, money market funds shifted cash out of reverse repo to buy T-bills instead. Since of course they could earn either the similar or ideally higher yield with the same safety. So essentially, the liquidity cushion, the point is it's already been used up. And just to be clear, money didn't just move from a Fed facility into T-bills and just sit there. That's how this works. Once it left the reverse repo pool, it funded government spending, meaning it's now circulating. It's in the economy. So you can't just pull it back instantly because it's in use. And that brings us to Ral's point. When liquidity dries up, normally the reverse repo pool, it acts like a buffer that can refill markets. But right now, Ral is saying it's basically empty. And at the same time, quantitative tightening is still draining liquidity because that doesn't flip until December 1st, as reported by Jerome Powell, the Fed chair. And the government shutdown, it's forcing the Treasury to build cash in its account instead of spending it. Okay? That's why markets, especially crypto, feel this liquidity squeeze so sharply. Since there's less money sloshing around, there's less money to go into crypto. But once the shutdown ends and the Treasury starts spending again, that liquidity comes rushing back. And that's the key point. In risk assets, especially cryptocurrencies, will feel it. That's the key takeaway. And all of these real world things, these macro considerations, they really do matter. And they really do impact the flow of money. And it really does impact, as a result, how much money flows into your whatever cryptocurrency you hold. It absolutely does. So it's important to understand all this. And then he says, this is hitting markets and in particular crypto, which is the most liquidity driven. Traditional finance asset managers have had one of their worst years of performance versus benchmark and are now having to chase markets, and that is allowing tech to be more stable than crypto. 401k flows help too. If this liquidity drain keeps going longer, stocks will get hit hard too. Yeah, and so the benchmark that he's referencing here, it's the S&P 500, and fund managers. This will probably shock you if you hadn't heard this already. I mean, you'll probably. But fund managers, this should be embarrassing for them. Fund managers underperformed. Pretty much, I think it was like the figure I think I heard, it might have been from Tom Lee. It was like 80% of fund managers have underperformed this year. And why? They tried to be smart. They bet on value. They bet on small and mid caps, stuff that hadn't rallied insanely yet. They bet on banks, energy. They basically tiptoed around the Magnificent Seven. But if you've been paying attention, you already know why that's a problem. It's because this year was driven almost entirely by mega cap tech. So anyone not heavy there got absolutely freaking wrecked versus the benchmark. And that was, as it turns out, most fund managers. And so the truth of the matter is, if you listening to this, if you just held like an ETF that tracks the S&P 500, you outperformed almost all fund managers. Think about that. And it's not like the thoughts behind, what these fund managers were saying. It's not like it all was crazy. So yeah, they were wrong about the Magnificent Seven, thinking that it probably peaked. It's not crazy to think that some of the other things that they put money in would never perform. They just haven't to this point. And so it looks really bad for them on paper. But the idea that you're never going to see like the Russell 2000 break upward, small cap stocks, like at some point it's going to. So it's not like these are the worst ideas, but it looks really bad on paper. So, I wouldn't want to be them and explaining this all to clients. I'm just saying that. But look, yes, sometimes the simple strategy does win. You own the index effectively. ETFs that track it anyway. You let the winners run and you just don't overthink it. And so anyway, Ral is saying here that once quantitative tightening stops and the balance sheet begins expanding again, even modestly, we can cross from a liquidity draining regime into a liquidity adding regime. And so in his view, that's the key macro switch that fuels the next big leg higher for risk assets, with crypto, again, of course, as I'll keep reiterating this, with crypto as the greatest beneficiary. He does then write, though, however, as soon as the government shutdown ends, the Treasury begins spending $250 billion to $350 billion in a couple of months. Quantitative tightening ends, and the balance sheet technically expands. The dollar will likely begin to weaken again as liquidity begins to flow. Tariff negotiations will have largely been completed, removing uncertainty. Yeah, and the tariff thing, I mean, that was never going to be something that was going to prevent us from like having an economy. There's some people that were talking back in April like it's the end of the world. Then you got the more recent scare in recent weeks, October 10th. You guys were there for that. None of this is the end of the world. That problem's going to eventually go away. It's just some really harsh sounding words that spooked markets. But as far as the dollar, look, when liquidity rises, dollars become less scarce and less valuable relative to other assets. And, and investors don't want to sit in cash. I mean, during a liquidity expansion think about it. Do you think that investors want to sit in cash in a liquidity expansion rather for exactly that reason? I mean, instead, investors want to rotate into risk assets like stocks and crypto. So, I'm just saying more liquidity usually leads to a weaker dollar and stronger markets, with crypto benefiting the most because it's the most volatile asset class. It just is. That's why we're here, right? Volatility is the purpose of investing. Without volatility, what the hell would we be doing here? I know you don't like it to the downside, but you like it when it's to the upside, and we know it trends to the upside if you let enough years pass, right? So, it doesn't take much money flowing into crypto to get substantial ROI. And then he says, ongoing bill issuance increases, adding more liquidity via bank balance sheets and money market funds and stablecoins. Ongoing rate cuts, we will have economic weakness from the shutdown that will add to the evidence that rates need to come lower, but no, there is no recession. Then he says, SLR changes free up more of the bank's balance sheets, allowing for a credit expansion. Okay, and so this one I actually hadn't heard of before in my entire freaking life, so I looked it up. Thankfully, it's nice to have the sum of all human knowledge at my little moon Lambo fingertips. It's very handy. And so anyway, SLR stands for Supplementary Leverage Ratio, and it's a banking rule that forces banks to hold a safety cushion of capital. And if regulators loosen that cushion, then banks suddenly have more room to lend and invest, which means more liquidity entering the system. That's why Ral Paul's talking about it. And so Ral clearly sees that specifically as another fuel source for markets and crypto once this tightening phase ends. So you can see there's a lot of moving parts to all of this. And that's why I keep saying, if you're only looking at charts and not taking into consideration any of this, you are missing crucial information, truly crucial information, and you're going to make a lot of bad predictions about what's going to happen. And then he talks about crypto regulation here. He says, the Clarity Act will get passed, giving the crypto regs so desperately needed for large-scale adoption by banks. It means what they needed. Adoption by banks, asset managers, and businesses overall. It says the big beautiful bill then kicks in the goose. Did I read that right? The big beautiful bill then kicks in to goose the economy into the midterms. The entire system is now being geared toward a strong economy and strong market in 2026 for these elections. China will continue to expand its balance sheet. Japan will work to strengthen the yen and also fiscally stimulate. The ISM will rise as rates fall and tariff uncertainty drops away. You just need to get through the window of pain, and the liquidity flood lies ahead. As he says, always remember the don't fuck this up rules and wait out the volatility. Drawdowns like this are commonplace in bull markets, and their job is to test your faith. Buy the effing dip if you can. And he says the too long didn't read version is, when this number goes up, all number go up. I like that. And of course, the chart on your screen here, it's the GMI Total Liquidity Index. And he's saying, as that goes up, everything goes up. Yes, which is why I keep highlighting there's no end-all be-all metric, but if there were one, it's what's on your screen right here. Total liquidity, folks. That's exactly right. And so he has cited a ton of reasons. And again, these are real things that really do impact how money flows around the entire planet to a gigantic degree. And again, so these are additional reasons, but even outside of that, at the big part of the core of his thesis is why the market length it's extending has to do with the debt refinancing. And that changes when money flows throughout the ecosystem. Liquidity increases, so money flows throughout the entire ecosystem, and it changes when it's going to happen because it's no longer the 4-year cycle if his thesis is correct here. So if that is indeed the case, that would absolutely explain why we haven't seen any of the the cycle top indicators trigger. And there's 30 of them tracked by coin market cap, 0 have triggered, but we're entering a bear market even though none of the cycle top indicators have triggered. Are they all broken? This would also explain, if Ral Paul's right, this would also explain why Bitcoin dominance hasn't plummeted. It would also explain why we haven't seen alt season. It would explain why we didn't see euphoria in the market leading up to this point. Where was all the euphoria? People were already down in the dumps before this recent pullback. Markets don't top in fear. None of this makes sense if we're entering a bear market. This time will truly be different in so many crucial ways that I can't even wrap my head around at this point. So if we're entering a bear market, fine, we'll do a post-mortem. I'll admit I was wrong, and we'll try and figure out what the hell went wrong. I haven't seen an argument that I find compelling. Like in any argument that's going to be compelling to me, it's going to have to include macro. And they're going to have to explain why all this stuff here doesn't make sense, even though it clearly makes sense. So you guys come to your own conclusions, but I'm just telling you this. And look, I'll flip and I'll say, hey, we're actually in a bear market if things shift. But it is way too early to believe that at this particular point. And I just don't see it. I do think that the best is yet ahead. Now, the good news is for someone like me, it doesn't matter what I think in the end, whether I think we're entering into a bear market or we're proceeding with a bull market. It actually, for me, it doesn't even matter if I'm right or wrong. And I admit I don't know for sure. I have my suspicions just like every other human. Like you have your suspicions. I'm entitled to mine as well. I'm just articulating them on my channel. That's why I have this channel, so I can talk about fun stuff like this. But for me, it's not going to matter because it won't, whether we're entering a bear market or continuing with a bull market, it literally doesn't change a damn thing that I'm doing all up in this bitch. I'm not going to change my investment strategy whatsoever. Period. All I do after I buy stuff is precisely nothing. I hold, and I will outhold anyone on the entire planet. I will do whatever it takes because I genuinely have that level of conviction and I have that level of patience. And the journey, frankly, it's fun. I even have fun in the bear markets. Got a couple of those, right? Ever since I jumped in 2017, we've been through a little bit of that. I'm still having fun because I understand the big picture, the opportunity. And during the bear markets, I was loading up on all sorts of coins, having fun running this YouTube channel. Like life goes on. It's great. And yeah, the euphoric part, when you get to the top, like that's the most fun. Let's be real. After you've been responsible preparing in the depths of the bear market, yeah, it's fun to see your net worth go up to ridiculous numbers. Like I get it. And it's not as fun when you get pullbacks like this. Okay, fine. But it's not the end of the world. And everything that we've seen here in terms of pullbacks, like it's just historically normal. There have been way bigger pullbacks like this. And there are a lot of pullbacks of greater magnitude, historically speaking, for Bitcoin and the crypto asset class, even as you go through the later phases of a bull run. So I'm just not convinced at this particular juncture in time that it's the end of the world. And if there are reasons that develop and they're compelling, then I'll just flip. And I'll be like, well, I guess I was wrong about that, and here's why. I just don't see it now. I genuinely don't. Because so many things would have to be different. But yeah, I mean, if you start seeing cycle top indicators start flipping, I'll be like, oh, okay. Well, now things are changing. That would be a thing. If I start seeing all the reputable chart analysts that I follow, because mind you, they don't go with the herd. If they start saying, okay, Yeah, it looks like we're actually entering a bear market. I would listen to them, and I would find just the fact that if a bunch of them are flipping, I would find that to be very compelling, frankly, because I know that they don't just go with the herd. They just don't just whimsically flip their points of view. I'm just saying there are things that could happen where I'd be like, oh gosh, maybe we actually are. Maybe this time actually is different. We're not there, and that is not what I think is the case. So we'll see here, folks. I'm just saying I think it makes sense to be very optimistic for the future here. And I'll reiterate, even if we were entering a bear market, if you just have a long enough time horizon, we win anyway. Crypto is here to stay. It's worth, it's down to what, 3.3? Yeah, 3.3 trillion. So it's up 1.1 trillion from a year ago. So that's still awesome. It's down from its recent high of about 4.2 trillion, somewhere thereabout. But if you fast forward into the future, that market cap for the entire asset class right here, it's going to be 10 trillion at some unknown point in the future, I think. Think then it'll be tens of trillions, and I don't think it's crazy to speculate that it'll at some point be over 100 trillion if you just let enough time pass. So we're still early, and that's why I say even if we were entering a bear market, like, it's not the end of the world. We still get our life-changing wealth. We just changes the timeline a little, okay? But we can't control that, so make peace with it. Let go of the things you can't control and control the things that you can control, and just be at peace with that. And what can you control? You can control whether or not you have exposure the next time the market rampages to the upside. And I'll tell you this, whether I'm right or wrong about the bear market versus bull market situation here, whether I'm right or wrong about that doesn't matter, because I am going to be here the next time the market rallies to the upside. So in the end, it doesn't matter. I win regardless. In the meantime, I'm just having fun talking about this stuff, okay? So yeah, if you were worried, I hope that this helped to some degree. I'm just telling you my opinion. I genuinely do not think it makes sense to be fearful here. The best is yet ahead. I'm not a financial advisor. You should not buy or sell anything because of anything I say or write. That would be a very, very, very bad idea. Until next time, to the moon, Lambo.